as soon as our speakers are here. Thank you very much. Ladies and gentlemen, please join me in welcoming all our speakers for this session on financing future growth. As I mentioned, we have with us an absolutely brilliant panel, and they're joining us on stage. Request you all to please join me in welcoming them. Okay, Mr. Sethi will be joining us soon. And however, we will begin the session on time. And I'd like to begin by inviting Mr. Rajiv Memani, President Designate CII, and Chairman India Region and Chairman Growth Markets Council, Ernst & Young, to give his opening remarks and take the session forward. So.
Hi, thank you. Very good afternoon to all of you. I think it's a real privilege to moderate an exceptional panel. We have the leaders of one of the leading stock exchanges of the world, one of the most experienced regulators, CEO of one of the largest infrastructure companies, and also one of the most seasoned and experienced private equity investors. So it'll be an interesting session. Before, I thought I will just put some introductory remarks and then hand it over to the panel and then follow up with some Q&A. All of us know the Indian economy is in good health, not only in terms of GDP growth, but also in terms of resilience. So when we look at the overall debt, the health of the banks, institutions, corporates, the buoyancy in the capital markets, I think overall the health and the resilience of the economy is pretty strong. And most people, most financial commentators would agree that the economy is well positioned to grow at 6.5% to 7.5% over the next 20-25 years, which would mean that the size of the economy would go up by almost 5 to 6 times over the next 20-25 years. So, but to achieve that, one of the things that is critical is to see, given how the economy is transitioning, is how does the gross fixed capital formation, which is roughly 28% of GDP, that will have to move to roughly about 35% of GDP. And to achieve that percentage, a lot of that will also have to be done by the private sector. If you look at, especially over the last few years, a lot of the infrastructure investment, almost 40 to 45%, has been through budgetary support, coming through being led by the government. But as we transition, it will have to be front-ended by the private sector. And if we look at individual sectors, there was an announcement almost 3-4 years back. The pipeline for infrastructure investment is close to $1.3 trillion. MSMEs have a demand of roughly $1.5 trillion almost every year, out of which $300 billion is fulfilled by the formal system. Some of it goes unfulfilled, and the balance is through the informal systems or the other forms of credit. We need almost $250 billion a year to achieve and arrive at our energy transition goals that we have set up. So each of them have significant demands. Historically, India, if I look at last 20, 30 years, has funded its growth mainly through domestic savings. There's not that much of overseas funding that's come through. But gradually, as physical assets grow, and also there is competition for domestic savings from the government to fund the fiscal deficit, I think we'll have to see how we mobilize more savings into private investments and also look at more foreign capital and see how FDI increases. And the savings are decreasing, and they're from roughly 20%, they have come to about 18%. FDI has been stagnant over the last 3-4 years, anywhere between 70 to 80, $85 billion. A lot of it private equity, almost $50-55 billion. And if you look at the India's share in foreign direct investment, global share, that's about 2.5%. So not relevant to the size of the economy. The other piece in terms of how we look at mobilizing savings better is to see how we develop corporate bond markets. It is progressing, but the way our equity markets are buoyant or structured volume depth, we don't have the same in the corporate market. So both in terms of good quality paper that should be there, and also large pool of investors from a supply side standpoint, I think that has to be there. And also how we open it up more and more for insurance companies, for pension funds, both in India and outside. The other area is in terms of allocation of funds from, especially if I look at the US pension funds, if we look at, they almost invest 50% of their capital in equity markets, about 20, 25, 30% in bond markets, and also about 15, 20% with venture capital funds. In India, depending on your vintage of pension fund, it could be anywhere between 50% to 75% with government. And also, we have about, in terms of insurance, almost 50% has to be invested with government. So how do we open up that pool better will also be interesting. And then I think we will talk about sovereign wealth funds and other things, but we'll leave that to the panelists. My time is the red light is flashing, so I'll have to stop here. But again, I will we will kick it off, and I will request Mr. Ananth Narayan, he's whole-time member of SEBI, for his address. Yeah, thank you.
Thank you so much, Mr. Memani, Mr. Sethi, Ashish, Dr. Jaishankar, and Amit. And thank you, CII, for inviting me to the second edition of the Global Economic Policy Forum. Rajiv was mentioning that some of us like coming to the podium and then we don't let go. I'll keep an eye on that timer out there so that I don't exceed my time. What I thought I'll do today is give you a regulator's perspective of this entire concept of financing future growth. What I thought I'll do is look a little bit to the back on one key feature which has been so instrumental in financing growth in the country over the last few years, which is the rise of the retail investor coming into capital markets. And I think it's a huge positive, even in terms of drawing in foreign flows, because of some of the advantages it brings in. From there, I wanted to segue into some of the opportunities and threats and challenges which go ahead in front of us, to make the point that there is absolutely no room for complacency to ensure that this capital formation happens and continues to happen. To start with, to remind ourselves, SEBI's mandate is largely threefold. It is investor protection, it is market development, and market regulation. Put together, our job is capital formation, to ensure there is sustained capital formation happening in the country. We are often seen as intrusive regulators with too many laws and too many regulations. That's not just our job. Our job is to ensure that a virtuous cycle of savers coming in, capital being raised, fresh capacity being formed, and therefore more savings coming into the cycle, that virtuous cycle actually ensues. And we have to keep reminding ourselves that capital formation is the cornerstone. Over the last few years, the ecosystem actually has done a tremendous job of drawing in fresh people into this capital formation cycle. March 2020, we had barely 2.2 crore unique mutual fund investors. Today, as of November, that number has crossed 5.1 crore investors. Likewise, in demat accounts, we had about 3.6 crore unique demat account holders as of March 2020. Today, that number has crossed 11 crores. It's about 11.4 crores. SEBI as a whole, we look at our ecosystem of individual investors who come in through mutual funds, PMSs, through direct investments in capital markets. The total number of unique individuals who were there at that point of time in March 2020, in some form or the other, was 4.9 crores. Today, that number is 13 crores. It's really grown. And this has been a fantastic story and a full kudos to the entire ecosystem, whether it is exchanges, clearing corporations, depositories, mutual funds, AMFI, brokers, investment advisors, the entire ecosystem. All stakeholders have played their part, including policymakers and regulators. While this is about also how do you draw in, foreign money, I don't know if you realize this enough. This large amount of flow of retail flow coming in, investor flow coming into the markets, actually has had a stabilizing impact in the markets here. Quick, recollection, between October 2021 and June 2022, when Ukraine happened, when the Fed started to hike rates, we actually saw $36 billion worth of foreign portfolio investors going out of the country at that point of time. Any other time, such a large concentrated outflow would have created an impact in equity markets as well as in currency markets. Instead, during that same period, purely in mutual funds alone, we saw over $40 billion of fresh investments coming in seeking risk, which completely negated this outflow which was happening in the FPI market. So much so that in 2022, India was one of the best performing markets despite all these outflows going through. More recently, October and November, we saw $14 billion of FPI outflows happening over a short 2-month period. The inflow which came into mutual funds during these 2 months, seeking risk, was exactly equal to $14 billion as well. So we've actually had a fantastic stabilizing effect on the markets. The volatility of our Indian markets has been low, and that is a draw for foreign investors as well. Having said that, as I said, no room for complacency. There's a long, long path ahead of us. So a couple of points I want to make. While we celebrate the growth of the domestic investor, this does not mean we don't need foreign investments. We absolutely require foreign investments, the point that Rajiv also made. So make no mistake, we have to ensure that we remain an attractive destination to draw in savings from the globe so that we can fund our future growth as well. Second, going forward as well, we can't take this inflow of fresh investors for granted. We've got to make sure that we not kill the goose that's laying the golden eggs, but we also preserve it. And there's a lot of work to be done there on an ongoing basis. I'm going to quickly touch about some of these things. One thing which worried us as a regulator was this mismatch between demand for paper and the supply for paper that we saw till recently. In FY24, the year that went by, if you see the amount of demand for paper coming through mutual funds and through FPIs, that was far in excess of the fresh paper being issued by way of IPOs, FPOs, QIPs, preferential allotments, etc. The mismatch was around 3.5 lakh crores. So, and which was a kind of a record of all times. Now, the regulator is the last person to talk about valuations, but when you have such a mismatch between demand for paper from these real investors and supply of paper, the question of asset, inflation and sustainability, etc., comes up. This year, I'm happy to report to you that the supply is actually caught up. We now have a record level of IPOs, FPOs, QIPs, rights issues happening. It's already a record for the entire year, even though we're only sitting in December. So till November, we've seen about 3.1 lakh crore of fresh issuances coming in, which is a record for all years so far in the history. The beauty is it's also accompanied by the record of all years for mutual fund inflows seeking risk. That's already at 4.3 lakh crores. So we are into a good thing of actually these two things going ahead. But as I said, we can't take this for granted. We have to ensure that we don't, we nurture this goose that's laying the golden eggs. So what are we trying to do in terms of improving supply and making it more efficient? We can't really address the real economy, but at least in terms of our processes, we are trying to ensure that IPO processes are made more efficient. SEBI is actually using its own in-house large language models to actually, and training them to actually process DRHPs and even PPMs of AIFs, etc., so that the efficiency comes into the actual IPO approval processes. When we talk about the number of IPOs that we do in India, and we speak to our counterparts in IOSCO and other countries, our numbers are staggeringly large, the number of IPOs that we are actually going through, and that process will hopefully continue in that sense. The second big theme for us, which you will see a lot of us speaking about, is investor education and investor risk awareness. There is, again, something that all of us in the ecosystem, whether it's AMFI, whether it's mutual funds, whether it's brokers, whoever, everybody in the ecosystem has to ensure that's done. We are worried that with the number of young people coming into capital markets, many of them glassy-eyed, many of them who have not seen an investment down cycle or a capital markets down cycle, is there really adequate risk awareness in the ecosystem? So what we are doing, by the way, we're doing a lot of work through AMFI, through the exchanges, through the clearing corporations, etc. But beyond that, we're also launching this survey, which we intend to use. It's a very wide survey across the country, to try and figure out three things really. One, what does it take to get more people into the capital markets ecosystem? People who have fixed deposits, how do you get them inside? Is it about risk perception? Is it about awareness? Is it about access? What is it that will draw more people in? But it doesn't stop there. The next big thing is, how do you get them to be more risk aware? We want people coming in with their eyes open, not glassy-eyed and expecting to become millionaires overnight. So what is it? What is their level of risk awareness? Are they adequately informed about the risks and the volatility? And the third important part, what are the gaps as far as this inclusion is concerned, as far as this risk awareness is concerned? How do we communicate and bridge these gaps in the most efficient way? What language, what medium, social media, newspapers, television? So we are doing this large survey, which will hopefully inform our investor education and awareness programs going forward. The third area, which Rajiv mentioned briefly, which I want to talk about, now that there is so much of acceptance of risk in this country and people are willing to come into the capital markets, I think it's extremely important that products such as InvITs, REITs, Munis, etc., start to show some traction. And you will see a lot of efforts happening from SEBI to try and make this happen. Monetizing existing infra, existing capital can be a great way of actually ensuring that sustained capital formation comes through. And here again, we will do a lot on education. We'll require the ecosystem to do that as well. But I think there are some areas where the industry should reflect as well. Things like, for instance, valuation of assets. Now, this is not a regulated domain, and as I said earlier, regulators don't understand valuation. We should not talk about valuation. But making sure that things like valuation, that there is no conflict of interest in doing the valuation, that there is sufficient disclosures of what's the assumptions behind the valuations, what is the range of valuations possible based on what assumptions you're making, and that there is sufficient accountability for your valuations, just as it is in the case of rating agencies. I think it's an area that we have to debate going forward. We don't want to get into regulating valuations, but if you want things like private equity, things like InvITs, REITs, Munis, etc., to grow, I think that areas require some attention as well. Fourth, in terms of improving our efficiency, improving our transparency, reducing the risk in the ecosystem, we'll continue to work. Actually, our settlements and payment systems are the best in the world. Ashish is here. The market infrastructure institutions that we have are absolutely world-class. But there is still room for improving efficiency and reducing risk. One quick statistic, the amount of cash collateral or cash equivalent collateral from investors, from traders, from individuals, which is sitting in the ecosystem between intermediaries and the clearing corporations, is about 4.5 lakh crores on a given day, on average. It's like a mid-sized bank by itself. And it's lying not within the banking system, it's actually lying with either brokers or with intermediaries or with custodians and so on and so forth. Now, that gives rise to hidden costs. The reason why brokerage is close to zero is because you actually have float income coming from those balances lying with you. It also creates risk because after all, these are not banks. So while we have lots of checks and balances, don't get worried, we have lots of checks and balances, but we would still want to strengthen that. And third, it is not transparent. You really don't know what charges you're paying. Now, improving these things with things like optional T+0 settlement or the ability for you to trade by doing a UPI block on your balances in the bank so that you can trade against that, leave the money in the banking system, with having transparent brokerage or intermediary charges, which is in a competitive market, set perfectly in a transparent manner, I think can go a long way towards improving efficiency in the ecosystem. Finally, a quick one on FPIs, because a part of the topic was also FPIs. As I mentioned, we are working a lot to try and make life easier for investments into the country. We often get feedback that our requirements are onerous. We are starting to listen to that feedback. For instance, for one large category of FPIs, we've reduced the number of fields that they have to input while coming in for an application by 45%. By simply working with them to see what is it that is redundant and still meets all the regulations required. Similarly, we have a FPI outreach cell within SEBI where we have spoken to more than 600 FPIs, where we are getting a lot of inputs on what we can do to make life easier for them. Finally, I want to quickly reflect on the session which happened prior to lunch, which was on regulatory, the point about regulations versus innovation. There's a lot of debate that often happens that our regulations, are they onerous, are they too much? I can tell you our thought process on how we approach regulations. We are mortally afraid of two kinds of errors. The first error is when we allow bad things to happen. So when a Harshad Mehta happens or a Ketan Parekh happens, that's a bad thing. The question automatically comes, what were you guys doing? Why were you asleep at the wheel? So that's a type 1 error which we always want to avoid. But we are equally conscious, I can assure you that we are conscious of a type 2 error as well, where our regulations become so onerous that they come in the way of good people doing their work. Now, it's a very, very tough balance. Statistically, it's impossible to minimize both type 1 and type 2 errors, but I think in regulations, it's possible. There are win-wins possible where you can reduce both these errors. And this is where we need a lot of consultation. We try to do a lot of consultation. We have advisory committees that tell us on every single regulation that we come out with or we propose, we have discussions around that. Every regulation that we propose is open for public consultation. Once it's done, we actually put it out as a principle. Then what it translates into as do's and don'ts for the people on the ground, even that we do a lot of consultation. So we try and do this in a consultative manner. My request to CII and all its members would be a part of this consultation process. It can be very troublesome. It can sound like a lot of work, but it's important that we kind of minimize both type 1 and type 2 errors. I see the watch coming down to the close. Very quickly, we've had a fantastic run on capital formation with the advent of the Indian investor. I think that trend should continue, but there is absolutely no room for complacency. Lots of work to be done to ensure that the risks are managed, education happens, people are risk aware, so that the sustained cycle of capital formation can happen. For our part, I try and assure you that we will try our best to minimize both type 1 and type 2 errors on regulation. Thank you very, very much.
Thank you very much, Ananth. I think clearly, I think the track record over the last 3-4 years in the way SEBI and all the others constituents have worked has really enabled, as you rightly said, domestic capital formation, which has given a lot of resilience to the Indian economy. I'm sure we'll have a discussion on type 1, type 2. I think that's a very interesting point. I'll now give it to Ashish for his initial remarks. He's the Managing Director and CEO of National Stock Exchange, and also is a very key player in the way the domestic capital formation and also international has happened in India. So over to you, Ashish.
Thank you, Rajiv. Ananth, dignitaries on the dais, friends, it's a pleasure and honor to be in front of you. Speaking after the lunch and also After the regulator, all your points have been taken. So while he was speaking, I was thinking, okay, all this data points are gone, now what do I need to speak? So I will try to still keep you entertained. In some ways, India is a unique country. Per capita income this year, because GDP data is actually what I call very low frequency data. Once a year, that also after the year is over, 6 months after that. So it's extreme low frequency data. Whereas what we trade in the stock markets is in microseconds. 1 second has a million microseconds. So we give you response in a millionth of a second. Of course, in next year, probably 25 or early 26, we'll give you response in the nanoseconds, which is 1,000 millions. Always a country with $3,000 per capita, or probably by this fiscal year end, you will see India had probably $3,200 or $3,300 per capita income. The economic theory says that a country with low per capita income cannot have a well-functioning capital markets for equities or bonds, because the poor people cannot save, and if they save, they don't trust even their brothers. How come a person sitting in, say, 2,000 kilometers away in Jammu or Srinagar or Dibrugarh or Jorhat, which are remote, not exactly remote, they are urban areas of India, but anywhere in the remotest part. Today, NSE is present in all PIN codes without Jan Dhan Aadhaar mobile on its own. In all PIN codes except 30 PIN codes in India. There are more than 19,000 PIN codes. I have investors sitting in Andaman Nicobar. I have investors sitting in Ladakh, the remotest corner of Ladakh, and so on and so forth. And 30 PIN codes which do not have investors yet is because most of them are airports where nobody can give their address as a home address. But effectively, how did this market come about in India, which is anomaly? There is no similar market in the world at $3,000 per capita income per year. There is no similar market at $6,000 per capita income. There is no market at $12,000 per capita income. There is no similar market at $24,000. 8 times more per capita income and not a similar market, except one, which is China, where if markets go down, government A team has to go and do the buying. In India, do you think anyone buys here if markets go down? Why I'm telling you this is, this market is basically a market of the people, by the people, for the people. 77 years of independence and 30 years of NSE. NSE started operations on November 3, 1994. That time, India's market capitalization was 4 lakh crore rupees. That is, give and take few, probably $100 billion or $200 billion in that range. Today, after 30 years, it's $5.4 trillion. That wealth, which NSE represents today, with 10.7 crore or 107 million people, unique investors, is 1/3 of India's wealth. You take all gold, you take all real estate, you take all buckets and tumblers and everything, add up equities, and that is 1/3 of India's wealth. That wealth is the wealth of trust. That trust of an investor sitting in Jorhat or Dibrugarh or Andaman or Nicobar, putting her hard-earned 1,000 rupees, that is $10, into a company sitting in Salem, in Tamil Nadu, they are never going to visit that company, but they have a trust that that promoter, that particular manager is going to make profits out of money I am putting, and then a leap of faith that if the profit is made, that person will not run away or not eat it up, but also give me my small little share of that profit. It's such a great leap of faith, right? India has become more trusting of its entrepreneurs. It is an unbelievable leap of faith that a poor country with per capita poor sort of $3,000 per capita income is still trusting its poor other entrepreneurs. It is unbelievable. Nowhere in economics, I mean, there are books written why poor countries cannot have good capital markets. Now, giving you the other side of it, that I give you a response time in microseconds, there is no similar market in the world. I'll give you response time in nanoseconds, there will not be similar market in the world. But on a good day, I get 2,000 crore orders. That is 20 billion orders in one day. 15 orders for every human in this country. In single day, in 6 hours, 15 minutes. 2,000 crore orders is slightly larger than UPI does in a month, 24 hours a day. 30 days a month, right? On a good day, we will receive 50% of all orders in the world, all exchanges put together. New York, Chicago, London, Japan, add their brothers, sisters, and we'll still be 50% of the world. People are investing in India's future. And that's why the topic that financing India's future, I have no doubt that if India is going to grow, it's going to grow on the back of the National Stock Exchange. So yesterday I was at TIE, the Indus Entrepreneurs Global Summit in Bangalore, and I said that if you don't get funded by private equity, venture capital, whoever they are, pension funds, come to NSE, we will fund you. Thank you very much.
Thank you, Ashish. I think clearly what the NSE has achieved in terms of sophistication using technology, I think even if you compare some of the settlement times between NYSE, NASDAQ versus NSE, I think the gap is already phenomenal and we continue to improve. I just want to over here recognize the presence of the Honorable Finance Minister of the Royal Government of Bhutan. Thank you, sir. Thank you so much for joining. Mr. Lenopo Leki Dorji. Thank you so much. And I was seeing that you were making all the notes. And I'm sure if you have any questions for all these gentlemen, we will definitely give you that the opportunity of doing so. I will now request Mr. Shetty just joined us as Chairman, State Bank of India. He just joined us. Welcome, sir. If you could make some introductory remarks from here or from wherever you feel comfortable.
Good afternoon, everyone. Thank you, CII, for giving this opportunity. I think when I was asked to be present on the panel here, I was just wondering what is that we can talk to global investors who are coming to India. And just for some of you who may not be familiar with SBI, SBI is the largest bank in India. And any number in India, of course, is large. We serve a customer base of 500 million. The demographics, one of the pointers which CII team mentioned is our customer base is a reflection of the demographics of India. Highly diversified customer base. We have 150 million financial inclusion customers who actually started the journey of banking with a zero balance in their accounts. And today, 99% of these accounts are funded as we speak, which means that the financial inclusion objective, which the primary objective of financial inclusion of having a bank account is tremendously fulfilled in this country. And that is where I think it's, both Ananth and Ashish have spoken in terms of how this financialization of savings from the banking system probably is flowing into some of these other investment opportunities. The moment Ashish keeps talking about nanoseconds, I'm worried. There's already started, there's so much deposits flowing into the equity markets and SIPs. But it is inevitable in a maturing economy. We firmly believe that some allocation of the savings happens to this investment options. The way the bank like SBI has presence in every pin code, every village, every town, the way the investor community is spread out is a testament that this financialization of savings is happening. Important points to note is in terms of, I think, the financial ecosystem obviously is influenced by geopolitics, but I think India is very well positioned. During my interaction with several regulators, several countries, SBI operates in 29 different countries, and we feel that among many developed countries and developing countries, India is uniquely poised to be an investment destination. So that's on the demographic front as well as on the geopolitical front. And if you come to the productivity gains in the financial ecosystem, I think the tremendous work being done by the both banking regulator as well as securities market regulator is paying a rich dividend in terms of adoption of these new age technologies, including AI, not only for productivity gains, it is also in terms of the risk management. Today, huge customer base, and I'll just give you, I think, while Ashish mentioned about NSE's ability to handle transaction, the UPI, the digital public infrastructure which is created in India, has tremendously transformed the way the people transact today. On a payment system, on the maturity scale of 1 to 5, 5 being the best, I think it is one of the countries which is rated 5. And the direct benefit transfer, which is happening through the Jan Dhan accounts, the zero balance accounts today, our data indicates that 40% of this direct benefit transfer beneficiaries transact through the UPI. There's a tremendous adoption of the digital payment system. So this ecosystem of adoption of the DPI, proper regulation of the markets as well as the banking system, and the strong balance sheet, the twin balance sheet advantage of banks as well as the corporates, set a stage for India to attract investments. And in terms of the banking support for the growth of the economy, despite whatever challenges are there in the liability management, the banking sector is riding on one of the most benevolent asset quality life cycles today. The balance sheets of banks are strong and cleaner, and they have the ability to fund the growth prospects of this economy. And while the credit growth in many sectors is happening, I think the attraction of the renewable energy, again, which is another theme what is mentioned here in the sustainability front, both banking system as well as the corporate bond markets, I think, should contribute in terms of funding the sustainability initiatives of the Government of India. And Government of India is as committed for the net zero journey. I think is much ahead of the commitments what India is committed for. And we are playing, as the largest bank in the infrastructure financing space, our role in funding the infrastructure. And I think India continues to be a great destination for global money to come in. Thank you very much.
Thank you very much, sir. You're absolutely right. The twin balance sheet advantage today is a massive strength as we look at financing our future. Can I request Mr. P.R. Jaishankar, Managing Director, India Infrastructure Finance Company, if you can make some introductory remarks.
Thank you, Rajiv, and thank you, CII, for having me here. Good afternoon to all of you. Yes, the speakers before me have already outlined the kind of attractiveness that the nation has, before us, and the kind of